What if I told you that you don't need to be rich to start investing? You don't need $10,000. You don't need a six-figure salary. And you don't need to be a Wall Street expert. What if you could start with just $100 a month? Now, $100 might not sound like a lot of money. You could spend it on eating out, subscriptions, shopping, or a few random purchases you probably won't even remember a month from now. But what happens if you take that same $100 and invest it every single month? Today, we're going to break down exactly what could happen if you invested $100 every month into an S&P 500 index fund. And by the end of this video, you may look at $100 completely differently. Let's start with the most important question. What exactly is the S&P 500? The S&P 500 is an index that tracks 500 of some of the largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, and many other major businesses are included in the index. Instead of putting all your money into just one company, an S&P 500 index fund gives you exposure to a large group of companies. In simple words,
you are not betting everything on one company. You are investing in a broad group of major American businesses. Now, let's imagine you decide to invest $100 every month. Not $1,000, not $10,000, just $100. Over 1 year, you would invest $12,000 of your own money. After 5 years, you would have invested $6,000. And after 10 years, you would have personally invested $12,000. But here's where investing becomes interesting. Your account is not only growing because you are adding money. It may also grow because your investments can potentially increase in value over time. This is where compound growth comes in. Compound growth is often called the snowball effect. Imagine pushing a small snowball down a hill. At the beginning, the snowball is tiny. But as it rolls, it can pick up more snow. And the bigger it becomes, the more snow it can collect. Investing can work in a similar way. Your money can potentially generate returns. And over time, those returns can potentially generate additional returns. Now let's look at a simple example. Let's say you invest $100 every month for 10 years. You put in $12,000 of your own money. If your investments perform well over time, your account value could potentially be higher than the amount you personally contributed.
The exact number is not guaranteed. The market can go up, the market can go down. But the important point is this. You are giving your money time to potentially grow. Now, let's take this a step further. What if you continued investing $100 every month for 20 years? Your total contributions would be $24,000. That's $100 at a time. 1 month after another, 1 year after another. And this is where many people make a huge mistake. They look at $100 and say, that's not enough money. But they are looking at 1 month. Successful long-term investing is often about looking at the next 10, 20, or even 30 years. Because time can be one of the most powerful tools in investing. Now, let's imagine someone starts investing at age 25. They invest $100 every month. They don't try to time the market. They don't panic every time the market drops. They simply continue investing consistently. Now imagine another person waits until age 40. They have more money now. Maybe they invest $500 every month. But they lost 15 years of potential investing time. This is why starting early can be so powerful. You may not have a lot of money today, but you may have something even more valuable. Time. And here's something important. The stock market does not go up every single day. There will be bad days. There will be bad months. And sometimes the market can fall significantly. This is the part that scares many new investors. They see their account drop and immediately want to sell. But let's think about this for a second. Imagine you own a small business. One day, someone tells you your business is less than it was yesterday. Would you immediately sell the entire business? Probably not. You would want to understand why.
Long-term investing requires patience. And that does not mean the market will always go up. It means investors need to understand that short-term price movements and long-term investing are two different things. Now, let's talk about a strategy many investors use called dollar cost averaging. The idea is simple. You invest a fixed amount of money on a regular schedule. For example, $100 every month. When prices are higher, you're $100 buys fewer shares. When prices are lower, $100 buys more shares. You are not trying to perfectly predict the market. You are simply staying consistent. And for many beginners, this can be easier than constantly asking, is this the perfect time to invest? Because honestly, nobody knows exactly what the market will do tomorrow. Now, let's go back to our $100 example. Imagine you start investing $100 every month. At first progress may feel incredibly slow. After one month, you may barely notice a difference. After six months, you may feel like you're getting nowhere. After one year, you have invested $1,200. But this is where many people quit. They expect investing to make them rich overnight.
And when that doesn't happen, they give up. But investing is not supposed to feel exciting every day. In fact, the most boring investing strategy may be the one you can actually stick with for decades. The real power often comes from consistency. Think about it. You don't need to make one perfect investment decision. You need to make many small, consistent decisions over a long period of time. Now let's talk about a question many people ask. Should I invest $100 if I have debt? The answer depends on your personal situation. High interest debt can be extremely expensive. Credit card interest, for example, can grow quickly. So before investing, you should understand your own financial situation. And remember, this video is for educational purposes only. It is not personal financial advice. But one thing is clear. Before you invest, you should understand what you are buying. You should understand the risks. And you should never invest money you may need for your immediate expenses. Now let's imagine the future. You start with $100 a month. Your friends are buying things. People around you are spending money on things they may forget about in a few months. But every month, you continue investing. $100. Then another $100. Then another. And after years of consistency, you may look back and realize something. You did not become financially successful because of one giant investment. You built a habit, and that habit gave your money time. So what if you invested $100 every month in the S&P 500? The honest answer is nobody can guarantee you exactly how much money you will have. Past performance does not guarantee future results. But the bigger lesson is much more important.
You do not necessarily need to start with a huge amount of money. You may be able to start small. You may be able to build a habit. And you may be able to give your money more time to potentially grow. Because $100 today may not change your life overnight. But $100 every month for years could potentially become something much bigger than you expect. So the real question is not, can I afford to invest thousands of dollars? The real question may be, can I start with something small and stay consistent? Start small, learn,